$35 trillion. That's not a typo. That's a number so large it barely feels real, yet it sits quietly at the center of the global economy like a ticking device no one wants to look at too closely. And here's the terrifying question you're not supposed to ask. What actually happens when governments can no longer pretend this debt will be paid back? Because sometime around 2026, that question stops being theoretical. Later in this video, you'll see why the collapse doesn't start with riots or headlines, but with something far more subtle and far more dangerous. This video is about what a $35 trillion debt bomb really means, not in abstract charts or political speeches, but in real life. Your money, your job, your savings, your future. Governments around the world have spent decades promising stability while quietly stacking obligations they can only service by borrowing even more. For years, this worked. Cheap money masked the problem. Growth hid the cracks. But now interest rates are higher, growth is slower, and the math is turning brutal. By the end of this story, you'll understand why 2026 keeps coming up in quiet conversations among economists, why collapse doesn't look like a movie, and why the real danger isn't default but what comes before it. To understand where this goes, we need to rewind to how this system was built. Modern government debt didn't start as a mistake. It started as a tool. After World War II, borrowing allowed nations to rebuild, invest, and grow. Debt was manageable because economies expanded faster than interest costs. That was the deal. As long as growth stayed ahead, the debt faded into the background. But something changed. Over time, debt stopped being a bridge to growth and became a substitute for it. When growth slowed, governments borrowed more. When crises hit, they borrowed massively. Each time, the solution was the same: push the problem forward. But here's where it gets strange. Debt didn't just grow during emergencies. It exploded during good times. Low interest rates created the illusion that debt no longer mattered. Politicians learned that voters liked spending without pain. Central banks learned they could suppress interest rates and buy government bonds, effectively financing deficits indirectly. And markets learned to assume governments would always be rescued. This was the turning point. Debt stopped being scary. And when something stops being scary, it grows unchecked. By the early 2020s, the numbers had become surreal. Trillions added in months, not years. Emergency spending turned permanent. Programs designed as temporary fixes became political landmines no one could remove. And then inflation returned. Suddenly, the trick that made debt invisible stopped working. Interest rates rose, and with them, the cost of servicing old promises. This is the dangerous part. Debt doesn't kill you when you borrow it. It kills you when you try to roll it over at higher rates. Think about what that means in simple terms. Imagine maxing out a credit card with a low teaser rate. As long as the rate stays low, you survive. But when the rate resets, your payment explodes. Governments are now facing that reset. Trillions of dollars in bonds are maturing and must be refinanced at much higher interest rates. Every percentage point increase translates into hundreds of billions in additional annual costs. And unlike households, governments can't cut spending easily. Their promises are baked into law, politics, and social stability. But here's what nobody tells you. Governments don't collapse the moment they can't pay. They collapse when confidence breaks. As long as investors believe a government will manage somehow, the system holds. The moment doubt spreads, everything accelerates. Bond buyers demand higher yields. Higher yields worsen deficits. Worse deficits confirm fears. This feedback loop is what turns slow decay into sudden crisis. And once it starts, it's incredibly hard to stop. Now, let's talk about why 2026 matters. It's not a magic date, but it sits at the intersection of several deadlines. Massive amounts of debt need refinancing around this time. Demographic pressures intensify as aging populations drive higher healthcare and pension costs. Political cycles converge with economic reality, limiting painful reforms. And global growth is expected to remain structurally weaker than in past decades. When you put these together, you get a narrow window where policymakers have fewer tools and higher stakes than ever before. But collapse doesn't announce itself. Creeps. First, you see temporary measures become permanent. emergency taxes, financial repression, capital controls discussed quietly, then normalized. Inflation framed as a feature, not a bug. Savings lose purchasing power year after year, and people are told this is normal. Ask yourself, what happens to your life when your money slowly stops working for you? Here's where the story gets personal. When governments are squeezed, they don't default outright at first. They look for ways to transfer the burden without triggering panic. Inflation is one way. It quietly reduces the real value of debt while eroding wages and savings. Another is currency depreciation, which makes imports more expensive and lowers living standards without an explicit vote. Then there's taxation, not just higher rates, but broader bases, fewer deductions, and more aggressive enforcement. This is the silent collapse phase, where the system technically functions, but trust erodes daily. But here's the turning point. Eventually, these measures stop working. Inflation creates backlash. Currency weakness scares investors. Taxes hit diminishing returns. At that moment, governments face impossible choices. Cut spending and risk unrest. Borrow more and risk market revolt. Or change the rules entirely. This is where history gets uncomfortable. When governments truly run out of options, they redefine what money means. Bank deposits are reclassified. Pensions are adjusted. Withdrawal limits appear. Not overnight, but gradually, wrapped in language about stability and fairness. People wake up one day to realize access to their own money has conditions. This isn't a conspiracy. It's a pattern. It's happened in different forms across different countries, and it always starts with the same justification. There is no alternative. But what about outright collapse? What does that actually look like? It rarely looks like chaos at first. Schools still open. Police still patrol. Markets still trade. The collapse is psychological before it's physical. Trust in institutions fades. Long-term planning becomes impossible. People focus on survival, not progress. Investment dries up. Innovation slows. The economy becomes brittle. And then, when a shock hits, there's no buffer left. This is the part that should worry you the most. A debt-driven collapse doesn't just reset numbers on a balance sheet. It reshapes society. The middle class gets squeezed hardest because it has assets tied to the system but lacks the flexibility of the wealthy or the safety nets of the poor. Savings evaporate. Career paths disappear. The social contract fractures. And once that trust is broken, it takes generations to rebuild. You might be thinking, surely governments will step in. Surely central banks will save the day like before. But here's the uncomfortable truth. The tools that worked in the past created today's problem. More money printing risks runaway inflation. Lower rates risk currency collapse. Bailouts risk moral hazard on a scale never seen before. Policymakers aren't stupid. They're trapped. And when leaders are trapped, they choose the path that buys time, not the one that fixes the system. So what happens to you if this continues? Your salary may rise on paper but fall in real terms. Your savings may be safe but steadily lose value. Housing may become less affordable even as prices stagnate. Opportunities shrink while risks grow. This is not a dramatic crash. It's a slow-motion grind that quietly changes what a normal life looks like. But here's the twist most people miss. Collapse is not evenly distributed. Some sectors, regions, and individuals adapt faster. Others are crushed. Those who understand what's happening early have more options. Those who trust that the system will always protect them have the least. This isn't about panic. It's about awareness. Because awareness changes behavior, and behavior determines outcomes. As we approach 2026, the question isn't whether the debt bomb explodes. It's how it's defused and who pays the cost. History suggests the cost is rarely shared equally. It's shifted through inflation, policy, and rules written in moments of crisis. And by the time the average person realizes what's happening, the decisions have already been made. So where does this leave us? It leaves us at a crossroads. Governments can attempt reform, but reform requires admitting the problem, and admission has political consequences. Or they can continue managing decline, hoping growth returns or distractions by time. Neither path is painless. But pretending the problem doesn't exist is the most dangerous choice of all. Here's the core insight you need to take away. Debt collapses don't happen when numbers get too big. They happen when trust runs out. When people stop believing promises made in the past can be honored in the future. And once that belief breaks, no amount of printing, borrowing, or rhetoric can restore it quickly. If this opened your eyes, stay with us. This story isn't over yet. The next few years will quietly redefine how money, power, and security work in your life. And the more you understand now, the less surprised you'll be later. If you want to keep following what's really happening beneath the headlines, make sure you're here for what comes next.